What if I told you that your insurance rate was decided long before you ever typed your name into a quote form? That the price you pay each month isn't random. It isn't based on what your agent thinks. It's based on a secret formula calculated by algorithms, risk scoring models, and a data profile of you that most people have never seen. Today, I am going to pull back the curtain on how insurance companies really decide your rates, and trust me, you will never look at insurance the same way again. Asterisk, asterisk, pause. Lean in. Asterisk, asterisk, if you think your agent knows the full formula, they don't. If you think your credit score only matters for loans, it doesn't. If you think being healthy automatically gets you low life insurance rates, you're wrong. The real story is bigger, deeper, more shocking, and it affects every American. Asterisk, asterisk, grab attention. Because right now, whether you realize it or not, you are being judged by dozens of invisible factors that determine exactly how much you pay, sometimes years before you actually apply. And insurance companies will never voluntarily tell you how these calculations work. But today, you get the blueprint. Most people think getting an insurance quote is simple. You fill out a form, answer some questions, get a price, and decide whether to buy. But the truth is far more complicated and, honestly, a little scary. Insurance companies operate on one core principle: predict the future. Their entire business model depends on estimating how likely you are to file a claim, get sick, have an accident, pass away early, lose income, or experience a financial disaster. And to predict your future, they use a massive combination of actuarial science, advanced risk algorithms, predictive modeling, decades of claims data, thousands of behavioral trends, your background, habits, lifestyle, and choices, and your personal data footprint. Yes, your data footprint. If you're in America, you have one, even if you've never seen it. Insurance companies use it to classify you before you ever get a chance to ask for a quote. Welcome to the hidden world of risk scoring, where companies decide whether you're a preferred customer, a standard customer, a substandard customer, or a high-risk liability they want to avoid. And every category changes your premium dramatically. Most people never know which category they fall into. Most people never realize how close they were to being approved or denied. Most people don't even know that insurers use data you never gave them voluntarily. But today, you're not most people. In this video, you're going to discover the exact formula insurance companies use to calculate rates, broken into 7 parts. The hidden risk factors you don't realize you're being judged on. Why two people with the same age, income, and health can get totally different prices. The single biggest mistake Americans make that skyrockets their premiums. What insurance companies pray you never discover. And most importantly, how you can use this knowledge to get better rates, lower premiums, and avoid being overcharged. This is the insider breakdown the industry doesn't want you to hear. Because the truth is, insurance companies don't make money by being nice. They make money by being accurate. So accurate, in fact, that big insurance companies employ mathematicians, statisticians, behavioral scientists, medical underwriters, financial analysts, and massive AI-powered risk engines, all dedicated to predicting your future. And today, you're going to understand their playbook. By the end of this video, you will know the exact levers that move insurance prices up or down, and how to control them. This is the closest thing you'll ever get to reading the algorithm. Let's get started. Insurance companies don't guess. They don't ballpark. They don't eyeball your application and hope they get it right. They use data-driven prediction models built over decades to determine exactly how risky you are. This is where most Americans get blindsided. Behind the scenes, every insurer has a proprietary algorithm, a digital brain, designed to answer one question: how likely is this person to cost us money? To answer that, the algorithm analyzes layers of information: your age, your occupation, your driving habits, your medical history, your family history, your cholesterol numbers, your build and body composition, your past medical procedures, your medication history, your lab results, your family's genetic patterns, your biological markers associated with chronic disease. And here's the part they don't tell you: even minor health issues, ones that don't affect your life, can drastically impact your premiums. Example: a perfectly healthy 32-year-old with slightly elevated cholesterol can pay more than a 45-year-old with great health metrics. Another example: 2 people with the same weight but different distributions, body fat versus muscle mass, can be priced differently. Insurance underwriters are trained to look for patterns that suggest increased risk. A family history of early heart disease, a history of smoking, even if quit long ago, past injuries that may lead to future claims. Conditions like anxiety or ADHD that correlate with certain risks, even height differences. Because extreme heights statistically lead to more medical issues. Nothing in your biology is viewed as neutral. Every detail pushes your risk score up or down. But biology is only half the story. In Part 4, we explore the factor that can dramatically change your premium even if you re the healthiest person on earth. You could be biologically perfect, but still get hit with high premiums because of your lifestyle. Insurance companies view your lifestyle as a window into your long-term risk, and their assumptions, fair or unfair, play a huge role in your final rate. Here are the big ones. 1. Smoking and nicotine use. This isn't surprising, but the impact is enormous. Even occasional nicotine use, vapes, cigars, patches can double or triple your life insurance rates, automatically move you into a higher risk pool, require more medical exams, extend wait times for approval even if you only smoke socially. You're classified as a smoker. 2. Alcohol patterns. Insurance companies pay attention to your drinking habits. Even moderate drinking, when combined with other factors, can push you into a higher risk tier. If you've ever had a DUI excessive consumption treatment for alcohol issues, your rates skyrocket. 3. High-risk activities. You may love adventure, but insurers don't. These activities automatically spike your premiums. Skydiving, scuba diving, racing, mountain climbing, aviation, even as a hobby pilot, MMA or combat sports, snowmobiling, helicopter skiing. Even if you do them safely, insurers categorize them as statistically deadly. For occupation, your job says a lot about your long-term survival odds. High-risk jobs equals high-risk insurance. Construction, mining, oil rigs, firefighting, law enforcement, commercial fishing, aviation, heavy equipment operation. Your job can increase premiums more than any medical condition. 5. Travel habits. If you frequently travel to countries with political instability, high disease rates, dangerous conditions, you pay more instantly. Lifestyle is the part of the formula that shocks most people because they don't realize insurers track it so closely. But in Part 5, we get into the category that affects nearly all Americans. Every single day. We're now in a new era. Insurance companies use more behavioral data than ever before. This is the part most Americans don't know about, because it isn't disclosed openly. Insurance companies can legally collect and analyze behavioral data from your driving apps, your wearable devices, Fitbit, Apple Watch, etc., your online shopping habits, your payment behavior, your financial transactions, your social media patterns, public data collected by third-party brokers. Consider this. If you use a driver tracking app from your insurer, they know your speed, your braking, your cornering, your late-night driving, your phone usage behind the wheel, your consistency. If you use health wearables tied to wellness programs, they know your daily steps, your heart rate, your sleep patterns, your resting metabolic rate, your workout intensity, your recovery speed. They build a risk profile more accurate than any survey could ever produce. Even your spending patterns matter. Studies show that people who pay bills late, people who frequently overdraft, people who use payday loans, people who have irregular spending habits, statistically file more claims. Insurers use this data quietly. They, DNT, need access to your private accounts. Third-party data brokers sell generalized financial behavior signals. You are classified, not by your bank, but by your behavior category. Welcome to the new world of risk assessment, where you DNT even realize you being evaluated. But in Part 6, we reveal something even more shocking. Your zip code may be affecting your insurance premiums more than almost anything else. Insurance companies don't only insure people, they insure areas. Where you live dramatically shapes your premium because insurers rank neighborhoods by crime rates, accident frequency, hospital access, traffic density, weather risks, fire protection, quality building materials, environmental hazards. 2 streets apart can mean completely different prices. Here's how insurers think. High claim areas equals high premiums, low claim areas equals low premiums, that's it. It doesn't matter whether you personally have ever filed a claim. If your zip code is high risk, you pay for it. Examples: Florida and Louisiana have skyrocketing home insurance due to hurricanes. California wildfire zones pay massive premiums. 8 miles away from active fires, urban cities often have high auto rates due to theft and traffic density. Rural areas sometimes have high life insurance premiums due to limited medical access. Even subtle geographic factors matter. Distance to fire stations, local building codes, neighborhood crime trends, road design, and safety. Weather unpredictability, floodplain changes. But here's the kicker. Insurers update geographic risk faster than most homeowners know. You may have lived somewhere safe for years, but if crime increases or local weather, you may have lived somewhere safe for years. But if crime increases or local weather patterns change, your premiums can rise even without a single claim. In Part 7, we bring it all together and reveal the part insurers don't want you to know. You can control more of your rate than you think. Now that you know the formula insurance companies use, here's the power move. You can influence most of it. Here's how to strategically lower your premiums across life, auto, home, and more. 1. Strengthen your credit-based insurance score. This can drop your premiums more than any other single factor. Steps: pay down credit card balances, set up autopay to avoid late payments, don't apply for too many credit lines. Keep your utilization low, avoid major financial red flags. This alone can save hundreds, sometimes thousands per year. To clean up lifestyle risks if you can lower your risk. Insurers reward you. Quit nicotine for 12 months equals huge savings limit. Higher risk activities reduce alcohol consumption. Improve sleep and fitness, especially with wearables. Maintain consistent routines. Small changes gives big insurance impact. 3. Choose the right timing. Timing can change cost. Buy life insurance when younger, apply after major financial improvements. Apply before job changes to high-risk fields. Lock in rates when you're at your healthiest. Insurance pricing is extremely time-sensitive. For shop around aggressively, do not assume loyalty helps you. Most insurers raise prices quietly over time. Compare annually. 5. Adjust your deductibles. Raising deductibles can lower premiums significantly. Just ensure you have savings to cover them. 6. Bundle policies. Home plus auto, life plus auto, renters plus auto, all create discounts. 7. Use a trusted independent agent. This is the secret weapon. Captive agents only quote one company. Independent agents quote dozens. More options equals lower prices. Now you know what almost no one else knows. The secret formula insurance companies use to calculate your rates. You've seen the invisible algorithm, the hidden insurance score, the biology factors, the lifestyle penalties, the behavioral tracking, the geographic risk scoring, and most importantly, how to use this information to your advantage. Most Americans never learn this. Most Americans overpay. Most Americans think insurers are guessing. But now you know the truth. Insurance pricing is a science, and once you understand the science, you can win. If you found this eye-opening, if you learned something new, if you want more insider knowledge that can save you thousands of dollars, then do this right now. Subscribe to the channel. You will get more hidden insurance breakdowns, insider secrets, and financial tools every week. Hit the like button. It tells YouTube this content matters, and it helps more people avoid being overcharged. Drop a comment below. Ask me anything. If you have questions about your rates, your situation, your policy, or how to get better pricing, leave it below. I reply to every comment. This channel exists to help Americans understand insurance the way the companies do. Thank you for watching, and welcome to the smart side of insurance.